Hi, I'm Aarti Krishnan and you're watching A to Z of stock market investing. Today we are going to go with B, bears and bulls. Typically, the stock market commentators on TV use a lot of animal allusions. Of that, bulls and bears are the most common phrases used in the stock market. A bullish market is one where investors are very optimistic. Investors are all keen to buy shares and there are very few sellers. So prices are consistently pushing higher and therefore the market is in an upward move. Similarly, a bear market is one where most people are pessimistic about the prospects of companies. Therefore, prices are consistently falling. You find that there are very few buyers as opposed to sellers. Basically, there's a very gory explanation for this. Bulls are supposed to throw their victims into the air while they goad them. So that's why when the markets are going up, it's called a bullish market. Similarly, bears are supposed to press their victims into the ground. So that's why a bear market got that name. Stock prices often move by huge margins during the day itself, during the trading session. So is this a bull market and a bear market compressed into one day? Not really. A bear market is one where the index, the benchmark index for the market, like a Sensex or Nifty, falls by 20% or more over a period of 2 months or more. Similarly, there's a definition for a bull market also. So any market which trends up by 20% over a time frame without witnessing any 20% correction, that becomes a bull market. Cyclical bear markets are short-term bear markets which quickly actually revert to mean. So you find the index falling by say 20% over 2 months, but it rebounds very quickly and goes back to the original level. So investors do not lose money for an extended period. Whereas a structural or secular bear market is one where the index keeps falling and falling, and over a period of many years people have lost a lot of money, right? The longest secular bear market that we have seen, and the most famous one, is the one that happened in Japan. Between January 1991 and January 2001, the Japan's Nikkei 225, it fell from nearly 38,000 points to 18,000 points or below. So that was a period where investors, even after staying invested in equities for a 10-year period, they lost a lot of money. Usually secular bear markets like the one that happened in Japan happen after a huge bubble has been in place, or they happen when the economy goes through a long recessionary period as Japan did. In India, actually the longest bull market we've had is between 2003 and 2008 when the Sensex went up by 614% in total. In the US, we had the longest bull market there between 1987 and March 2000. Everybody knows what happened in March 2000. There was a dot-com crash and tech stocks crashed very sharply. 7 years before that, actually the S&P 500 in the US gained 580%. The jury is still out on whether the current stock market rally that we are seeing in India is a secular one or a cyclical rally. Already we've had the Sensex going up from say 15,500 points in 2011 to about 30,000 points now. That's a 94% gain. However, people say that because corporate profits are still very subdued and because the Sensex had 6 years of doing nothing, we are just at the beginning of the next big secular bull market. But don't think traders are always fond of bulls. In India, traders took great exception to a bronze bull being installed outside the Bombay Stock Exchange building in 2008. The bull was installed on January 11th, and soon after it was installed, within a couple of weeks, the market crashed big time. This flagged off the longest bear market in India till date, which began in 2008 and ended only in 2013.